Well, let's get started. So good afternoon, everyone. My name is Scott Vandenberg, and I am the president here at Century Management. And first and foremost, I would like to wish everyone a happy Hanukkah, Merry Christmas, happy holiday season in whatever way you might celebrate. And I'd also like to wish everybody a very safe, happy, healthy, and prosperous new year coming up. Now, we have just about 12 business days left in 2023, so we thought it would be a good idea to share some thoughts on how you might still potentially improve your finances and hopefully lower your taxes a little bit in 2023. So we also want to touch on a few wealth management topics that we think can help you in the years ahead. So joining me on today's call is my colleague, David Lloyd. David has more than 3 decades of experience in the financial planning area. He's the director of wealth planning here at Century Management, and he is a certified financial planner and a certified trust and financial advisor. I'm also on today's call joined by Rachel Vandenberg. Rachel is a wealth planning associate here at Century Management, and she holds a master's degree in taxation from Baylor University. And I'm smiling now as a proud father because I'm happy to say she's also my daughter, and now the 3rd generation family member here at the firm. So David and Rachel, thank you for joining on the call today.
Yeah, thanks.
Yeah,
I'm happy to be here.
Scott.
Really excited.
This is great. Launching a new era.
Yeah. All right. So before we get started today, I just want to let y'all know this is going to be recorded. And so in the next few days, we'll send out the slides, the recording, and a couple other handouts that we have. And we have 7 topics that we're going to go over today. So as we're talking, hopefully this Q&A part should be working. So if you have any questions, feel free to chat them or put them in the Q&A, and we'll go ahead and answer them at the end. All right, so to start us off, Scott, let me ask you, before we end this year, and as we're starting to think about 2024, what is the one piece of financial advice that you believe can have the greatest impact on a family's financial situation?
Well, personally, I believe every individual, family, and business owner should go through the process to create a comprehensive wealth plan, a financial roadmap, if you will. And I'll tell you that after 32 years of being in this business, it's been my experience that many people spend more time planning their family vacations than they do their family financial plan. And this can really mean the difference between reaching your financial goals and having peace of mind, or being in a position where you don't have enough to retire, or maybe you have to come out of retirement at the risk of outliving your money. So I truly believe people can put the odds of financial success in their favor by putting together a well thought out financial roadmap incorporating all their financial moving parts, their short, mid, and long-term goals. And one key feature in building out this type of financial roadmap is that it gives you a chance to model and run out many, quote, what if scenarios to stress test your plan for both the expected and the unexpected that may, come our way. So here are a few of the questions that, we typically start to address. It's not all of them, but I'm going to give you about 10 questions that we would ask in creating a wealth plan, wealth roadmap for our clients. First, are you funding the right type of retirement account, one that allows you the best tax advantage now and into the future, as well as the most opportunistic funding limits? Do you have enough emergency savings and liquidity to help get you through an unplanned event such as a job loss, an illness, or maybe a severe market meltdown? If there's an unexpected death of yourself or your spouse, can the surviving spouse and kids continue to live the same lifestyle? What if you have a long-term care event, which puts you in a position to have to fund medical expenses not covered by medical or insurance or Medicare that could run you north of $100,000 per year for a few years? Are you prepared for that? If you're withdrawing funds from various bank, brokerage, and retirement accounts to supplement your income to use for a major purchase or a donation, are you doing so in the most tax efficient manner? Are you making the most of all the tax credits and refunds available to you as an individual, a business owner, or a rental property owner? While you may look at your individual accounts kind of in a silo or standalone basis, have you reviewed them at your household level to make sure that when you combine all of your accounts. You're properly allocated at your household level across all asset classes, such as stocks, bonds, cash, real estate, commodities. And at this household level, are you in compliance with your own personal risk tolerance and objectives? And just a few more here to spark some thought. If you're widowed, divorced, or in a second marriage, have you worked out all the new financial moving parts as to how your family will manage income needs, risk appropriate investments for growth, as well as asset protection? Do you have even the most basic of estate plans with a will, a trust, a medical powers of attorney, advanced medical directives? Are your beneficiary designations current, up to date? And then if you're a business owner, laying in the complexities of owning and operating your own business into your family financial plan, I think is a must to help you ensure a smooth transition to a planned retirement, or to help you have thought out, while not under duress, the impacts of the potential unplanned exit or transition from your business. So these are just some of the questions and topics that we cover in our planning process. There are many more. It's always specific and tailored, to the client. But again, most people haven't thought about their finances in this more comprehensive context. And so when you ask, what is the one piece of advice I can share? It would be to create this financial roadmap, this more comprehensive plan. You invest the time up front, and then there's annual updates. I think it can make a real difference.
Yeah, those are all really great points. And I just encourage all of y'all on the call today to, as you have some hopefully extra time over the holidays, to really think about what's important to you in your finances and see how we can maybe help you with a financial plan. All right. So moving on, let's talk about funding your retirement accounts. So David, what are some accounts that are available for individuals to fund their retirement?
Okay, thanks, Rachel. Well, I'll start off by saying we all know that we need to save now if we want to be in good shape for retirement. So there are all kinds of investment accounts, but let's focus on the ones that are at this point that are specifically designed to encourage retirement savings. And so because they're the best deal going. And it's an IRA, it's IRAs, individual accounts, individual retirement accounts, and employer offered plans like 401k, 403b, 457, those types of things. So as Scott, I think one of his points was, are you funding the right type of retirement account, was one of the questions he asked. And to answer that question, we need to understand how each account works. So the most common employer accounts, so let's just start off by describing the types and their characteristics. The most common employer accounts are funded often with employee and employer matching contributions. So right out of the gate, saving for retirement, you should at least put your first saving dollars into the employer-sponsored plan so that you qualify for your employer's match. Otherwise, you're leaving free money on the table. But if you may not have that option where you work, and so then you need to fall back on an individual retirement account. This is an account where you are in charge, not your employer. So there's two types of IRAs and two types of employer-sponsored plans, and I would call them traditional and Roth. And about 90% of employers now offer Roth options in their company-sponsored plans. And so we would encourage you to consider making Roth contributions to your employer plan. And if you aren't doing that now, you just need to talk to the plan administrator to see if that option is part of the plan. So the major differences between a traditional and a Roth are that the contributions to a traditional account are pre-tax. And that means you get a tax deduction now, which reduces your taxable income now. The Roth contributions are after tax, meaning you pay taxes now. So, but there is something common about both of these types of contributions, and that is the growth or the appreciation in the accounts is not taxed while it's growing, while it's in that account. But the bigger difference is what happens when money is distributed in retirement, usually after 59 and a half. That's where the real difference is. So from a traditional account, their distributions are taxable, just like a salary, treated the same way from a tax standpoint. And, it kind of makes sense because your contributions, when you put them in there, were tax deductible. So Uncle Sam's going to get his little pound of flesh when you begin to take money out. Now, Roth, on the other hand, are not taxable. The distributions are not taxable. And again, thinking back, the contributions are after tax. So you've already paid tax on the contributions, and but the benefit is that the growth is not taxed when you take it out. So that's a really unique and important feature of the Roth type contribution or account. A couple more things to know is that there are limits or rules about them. If your income is too high, you may not be able to contribute to a traditional or a Roth IRA, and that there are contribution limits, meaning that you can see it on the slide that Rachel's showing. There are limits to how much you can put in on every year. So that's, I would say, describing the big differences between how an individual can save. So I'd leave it at that for now.
And we just want to bring this to your attention before the end of the year. So if you have the opportunity with your plan administrator, if you have one of these employer sponsored plans, you can, if you haven't already, try and make some more contributions before the end of the year, because that contribution deadline is 12/31. But you have a little bit more time for your IRAs. You don't have to get those contributions made till April.
Good point, Rachel.
All right. So kind of going back to the Roth versus traditional, David, why would someone think it's beneficial to have that tax benefit of the Roth when they could save taxes now? Can you talk a little bit more about that?
Yeah, it may not make sense. Like I could get lower taxes now by just using a traditional contribution. But again, the most important thing about a Roth is that it's never taxed. And so the growth is tax free. And that's a rarity in our tax system, and it's hard to beat. So when your assets grow from 10 to 20,000, that extra 10,000 never being taxed, no matter at what time, is a really important feature. And I'll just give an example. If during your working life, excuse me, you contributed $50,000 to a Roth IRA and it grew to 100, and when you became 59 and a half, that $50,000 increase comes out without any taxes. It's tax-free growth. And another important feature is you do not have to take required minimum distributions from a Roth, whereas in a standard or traditional IRA, you do. So you're forced to take money out whether you need it or want it, or whether it's tax advantageous to you or not. So I'd say that's why you would really seriously consider a Roth.
Yeah, that's helpful. Thank you.
Yeah, and I would just add that also for those of you that have children or grandchildren that maybe have a little bit of earned income from working in the summer, or just young people that have some type of reportable income for tax purposes, you may want to encourage them to open up a Roth IRA. So, they earn $1,000 in the summertime of some taxable income, then they could contribute up to $1,000 into their Roth. And even a small amount like that for a very young person that's going to have 35, 40, 45 years of compounding on their side, that can really make a material difference over time. So one of the things that we've talked about is even as a way to encourage your kids is maybe even to offer them a match. If they earned $1,000, have them put $500 into a Roth, and then you put in $500 into that Roth to match them on their behalf. Now, it can't be more than what they earned from a taxable wage, but maybe some type of match just to give them a little bit of nudge in the right direction. So
yeah, Scott, I did that with my kids, my sons, who are now young adults, and it worked. They contributed, and they've continued now. They're in the habit of doing it for themselves. So it's a really powerful incentive, I think. Worked well.
Great.
Yeah, that's great. David, are there any other investment accounts worth considering funding this year?
Yeah, a couple. A spousal IRA, just to make you aware of it, is you have two spouses, one has earned income, one is a non-working spouse. The non-working spouse is allowed to have an IRA too. It's called a spousal IRA. It's subject to the same IRA, the income and contribution limits as a regular IRA. So you don't have to, if you're a spouse, and not working and have no earned income, you can still have an IRA. And I would say, then there's one more that I want to mention, and it's a health savings account. This is available for individuals with high deductible health insurance plans. And it's a very powerful tool if you can use it. And it does have contribution limits. And in 2023, it was $3,850 for individuals, $7,750 for a family, a little additional $1,000 if you're 55 or older. I call this the granddaddy of them all. I mean, we've talked about Roths and IRAs and the tax benefits of each of those and contrasted them. The Roth is certainly a powerful tool, but this is even better than a Roth, and that's because it has triple tax benefit. The contributions are tax deductible and before FICA taxes, meaning Social Security and all those sorts of taxes that come out of your paycheck. Obviously, the tax-free growth, and then you get tax-free withdrawals for qualified medical expenses. It's a very flexible plan with no minimum age requirements for withdrawing tax-free, no required minimum distributions. And as far as distributions go, there's kind of two ways to look at it. It can be use as you go or let it grow. And use it as you go just means you put in $6,000 in a year and you withdraw $6,000 out to pay for qualified medical expenses. And that's okay. That can be very useful. It's still beneficial because of the tax deductible nature of the contributions. But the let it grow is what we want to encourage people to consider, because Scott, I think in his list, mentioned we could help sort of plan through unexpected events like illness or long-term care. And so if you let this very powerful account compound and grow in this tax-favored way and not spend it every year for medical expenses, in other words, pay for reasonable medical expenses out of pocket, this can become a very significant savings account for future medical needs, even long-term care, and when you're older and have more medical expenses. So the only thing you need to know about it is you keep track of your legitimate or qualified receipts, and you keep them in a record that you can refer to. And even 20, 30 years in the future, you can then claim against those historic expenses and pull a lot of money out for perhaps all at once if you had an emergency. So there's just a quick overview of the HSA. So
Great.
Rachel, I think there's one more kind of account that you're going to help us learn about.
Yeah, I just wanted to talk to y'all a little bit about 529s. So 529s are a type of college savings account. It's after-tax money going into it, just kind of like a Roth, and then it grows tax-free, and it comes out tax-free as long as you're using it for a qualified education expense, which could be college, whether that's a traditional university or community college, grad school, whatever. It could even be technical and trade schools, seminary schools, books, room and board. It can really be used to cover a lot of ground. And I want to bring this up to y'all before the end of the year, because the contribution limits are your annual gift tax limit. So I believe that this year that's $17,000 as an individual. And then if you're married, it's $17,000 per spouse that you can give to each person you're giving to. So if this is something that you're interested in, I would definitely encourage y'all. That's the max. You don't have to do that full amount, but to the extent that you do want to contribute to 529, definitely do that before the end of the year, before those gift tax limits resets. A couple quick points on 529s. You can change the beneficiaries at any time. So let's say you've got 3 kids and you've got money left over from the first 2. You can use that for your third. After the third, you still have money left over. You can keep it in there until you have grandkids, or if you needed it, you could pull it out and pay a penalty on it and then pay income tax on it. Now, let's say you have all of these savings, but your kids or grandkids got scholarships. You can take that money out without the penalty, which is 10%, and you just pay income tax on the growth. So one thing that I really like to encourage, I've got 2 little kids, and if your kids or grandkids are anything like mine, we've got way too much stuff. So when people ask, what do you want for the holidays or birthdays? I say, you know what would be awesome is to contribute to their 529 account. So you can send out, if the parents have one, or you can make your own, you can send out a link or just contribute to the 529. And that's a great little gift. And if you have any more questions on this, just feel free to reach out to me and we can talk more about that. All right, so shifting gears. So that's topic 2. So now we're moving on to topic 3, just to kind of keep the pace for everybody. Let's shift gears from talking about individuals to business owners or self-employed. So Scott, can you talk to us a little bit about what kind of retirement plans are accessible for people that fall into this category?
Sure. So the good news is there's many planning options to choose from. And when choosing a retirement plan that's right for you, a business owner should consider a number of factors, such as the size and structure of their business, their employee demographics, such as age, salary levels, turnover rates of employees, the contribution flexibility, whether they want to commit to a contribution every year or not, what are the administrative costs, tax implications, their long-term business goals, cash flow considerations, and what kind of compliance and reporting requirements are needed. So at the bottom line, while there's a lot of moving parts to consider, it's been my experience that working through these questions and helping clients find the right retirement plan for their business has really been a difference maker to a lot of people. So let's take a look at this first slide. It says if you have few to no employees, so it's just yourself or maybe yourself and a spouse or just a couple of employees, these are the 3 that you'd really want to consider. In the first column, you see an individual or solo 401k. Now this can only be used if you are an owner or an owner and spouse. You can't have any employees, but because you don't have the fiduciary responsibility for other people besides yourself, the government allows you to have a very streamlined administrative and compliance process. So there's very little, if any, paperwork to have to file. You can set this up at no cost. And it has the same benefits as a traditional larger company type 401k plan. And you can see that an employee, if they're over 50, could contribute $30,000, meaning you reduce your salary by $30,000 to contribute to this plan. Now that's with your employee hat on, but you are also the employer because this is your company. So when you put your employer hat on, you could also contribute an additional 25% of your adjusted gross income. So if you were able to max it out, all the stars were aligned. If you're over 50, you could put in $73,500. Now, the next popular one is a SEP IRA. And again, there's no paperwork annual paperwork or filings needed with this, but it can become expensive if you have a lot of employees because the funding here is 25% of compensation. So if you have a lot of employees, you'd have to put in not only 25% for yourself, 25% for each of those employees. So if you have 1 or 2, maybe it's an option to consider, but beyond that, I think it's probably too expensive. But it is an easy way to get some money into a retirement account. My favorite for this situation where you have just yourself or a few employees and the cash flow to do it would be to set up a defined benefit plan. This will give you the highest contribution limits. They'll be tax deductible as a business expense. Typically, there is about $2,500 to $3,000 in the initial setup costs, and then there's an annual administrative fee of probably $1,500 to $2,000. But the formula is largely based on your age, income, and years of service. So you are able to contribute the lesser of your 3 highest years of consecutive salary or $265,000. So if you're making a lot of money, you can see the maximum contribution here at $265,000 versus, say, the individual 401k at $73,500. It's materially different. So that's why we help a few people do that every year, and it works out great.
Yeah, and Scott, you mentioned that the contributions are tax deductible as a business. Can you just elaborate on that?
So all these contributions that you're making are tax deduction to your business. The only one that wouldn't be tax deductible would be in the individual 401k if you chose to contribute, now with your employee hat on, to the Roth portion of that 401k. That particular contribution is made with after-tax dollars. So from an employee perspective, you couldn't deduct it, but all the other contributions would be deductible.
And when you're saying that, you're saying deductible as a business expense, potentially lowering business taxes.
That's correct.
Awesome. All right. So can you talk to us about options for people with more than a few employees?
Yes. So if you have more than a few employees, these would be the three options that would be available to you. First is a simple IRA. You can have up to 100 employees. It's primarily funded with employees taking a salary reduction to fund their individual IRA accounts under this simple framework, and the business owners can make some contributions. But I'm not going to spend any more time on this because to have this in place, it had an October 1st deadline, so we're too late for this year. So I'm just going to keep moving on. A 401k, which most people have heard about, is a good option for a larger company. It permits high funding levels for employees, and then an employer can make matching contributions, and they can also make profit sharing contributions. And you can see the contribution limits for this type of 401k are the same that we saw in the individual or solo 401k. But my favorite one to encourage business owners to employ that have fewer than 50 employees would be the combination of a 401k plan with a cash balance pension plan. It's a type of defined benefit. But when you put together those two, it's really significant, the savings that can be put away. Yes, there's say $4,000 to $6,000 worth of startup costs. But if you look towards the bottom right quarter of the slide, you'll see that if the employee maxed out their part of the plan and the company maxed out the profit sharing that they would give, as well as fund the cash balance, all in, a 40-year-old could have $180,000 going into this type of plan, all the way up to a 70-year-old that could have $471,500 going into this type of combined plan. So in a situation where someone has significant cash flow and you're looking to reduce your taxes, as well as create some asset protection, this is a great vehicle, because when you're in a 401k plan or a cash balance type pension plan, those are typically creditor protected and judgment proof, meaning, well, let me give you the best example. Take O.J. Simpson. He lost a civil trial, had to come up with a lot of money and sell a lot of possessions, but he had a defined benefit plan, again, like a cash balance, and that was off limits and couldn't be touched as part of an asset that could be attached to pay his fines. So while I'm sure there's probably some way somebody could penetrate it, it would be very, very difficult, because these are governed by federal rules. And like your homestead, your primary residence is protected. This type of retirement vehicle is also great asset protection. And I just want to share with you two examples where we've been able to use some of these plans for clients. One is a client was self-employed, no other employees, was right around 60 years of age, making some very good money, and he was funding his SEP IRA, maxing it out at about $60,000 a year. But after we walked through a little more, dialogue with each other, I was able to recommend to him that he create a defined benefit plan. And at the end of the day, he was able to contribute $265,000 a year to his plan each year for 10 years. And in each of those contributions, he was able to save more in taxes, and he was even able to contribute to the SEP IRA that he had done these previous years. The other example is a couple that has a small business with about 18 employees, but they didn't have a company retirement plan. They were just funding their individual IRAs. So again, after walking through the planning process, I realized they could really benefit from this combination 401k and cash balance plan. And because not only would it be a great way for them to save in taxes, but they'd be able to create some employee benefits. And we know that when you create employee benefits, it helps you reward, recruit, and retain your employees. So when it's all said and done, this couple was able to put about $300,000 away into these retirement plans, about 85% of that contribution went to them as the business owners, but the tax savings that were generated to them was enough to not only cover the administrative cost, but it fully funded a 6% of salary contribution to each of their employees at no cost to them because it came from the tax savings. So that was a real win-win situation. So those types of things are exciting if you have the cash flow to do that.
Yeah, that definitely is exciting. Okay, shifting gears off of our retirement accounts, David, can you talk to us about any tax saving options we have for taxable accounts?
Yeah, just to give everybody a heads up, we're probably hitting towards halfway through here at this point and on the downhill slope. So since we're at the end of the year and this idea of tax loss harvesting is being tossed about, and you probably heard people talking about it, I thought, well, at least let's take a short amount of time to be informed and understand it. But the first thing I would say about tax loss harvesting is more of a warning than anything. And it's a very popular strategy, but it needs careful consideration. And the benefits may not be as good as they seem at first look. But so always talk with a tax professional or financial advisor to make sure that tax loss harvesting aligns with your personal financial goals and tax situation. So just a quick explanation of what tax loss harvesting is. So it's when you sell an investment, it could be stocks, bonds, or even a business or rental property, and you're selling them for a loss. They've gone down since the purchase to offset a gain that you have acquired through some other asset, and those gains have been realized. So the loss you take that you harvest can minimize your current tax burden, and that can decrease it will decrease your current taxable income. Just so you know, tax losses and gains, frankly, can be short or long term. But these are some of the things I think you need to keep in mind. When you harvest a tax loss, you can't purchase the same or substantially the same security within your household within 30 days before or after the sale. Otherwise, it'll be disallowed. It's called the warped sale rule. So you have to keep all that timing in mind. Now, tax loss harvesting can be valuable as I described it, as long as especially if you have no intention of buying the harvested stock back. But if you intend to buy it back, the benefit isn't really guaranteed. And that's because during that 30-day wash sale rule waiting period, the stock that you harvested the loss in, that you sold, could appreciate and offset the tax benefit. So that would nullify the whole exercise. And if you intend to buy the stock back, you're buying it back at a lower cost basis than the original stock that you harvested, which means you're basically deferring or pushing a larger capital gain into the future when you do ultimately sell it. So that would be fine if there was some certainty that the capital gains rate in your future would be lower. That would work out great. Who knows for sure though? But if your capital gains were taxed at a higher rate in your future, this strategy could actually backfire and be wealth destructive. So I would just, again, I'll stop right there and just say, if you're considering tax loss harvesting, you need to talk with your advisor, money manager, or a tax person before you do it.
Mm-hmm. Yeah, that's great. Thanks, David.
Yep.
All right, moving on to our next topic. As we come to a close this year, it's a great time to check in and review your investment. So, Scott, can you chat a little bit with us about how we go about this review process?
Yes, sure. So I think when you're reviewing your investment accounts, they should be reviewed from three different perspectives. One is on an individual account basis, two on a combined account basis, and three in the context of your overall financial plans. And so let me share with you the reasoning behind this thinking. I think the benefit of looking at each account on an individual basis is that you can confirm the investments are appropriate and in alignment for each of the account's intended goal or purpose. And here you're taking a look at things like time horizon, tax consequence, your risk tolerance, and how the assets are allocated, for that specific goal. But for example, because of its tax-free growth and tax-free withdrawal characteristics, both Roth IRAs and Roth 401ks, I believe, should typically be more fully invested in stocks and stock-based mutual funds compared to other investment choices. So while being invested more in stocks and equivalent funds subject you to more volatility and potentially risk, over the long run, a diversified basket of stocks as an asset class should provide superior returns relative to bonds, CDs, commodities, and cash. So when you compare a Roth retirement account to other types of taxable and non-taxable accounts, it's usually the last place you'd want to source an income stream or take a distribution from, given its tax-free benefits, which means it has the longest time horizon of your investment accounts. And so because it has that long-term time horizon, it could be invested more aggressively. So compare this to an account that's set up to eventually pay for college tuition, purchase a home, pay for medical expenses, or maybe it's your rainy day fund. Those accounts you would not want as fully invested and aggressive in stocks because they have a shorter time horizon and you need the money, at a specific point in time. So there's going to be some level of balance in those types of accounts. So that type of review on an individual account basis is really important. Now, the benefit of looking at all your investment accounts combined, which I refer to as the household level view, is that you have a chance to review your total exposure to investments, whatever they may be. And specifically, it allows you to review at your household level your exposure to any one asset class, any one security or investment, any one market sector, or any one geographic or country exposure. So this combined household level view can help you put into context your family's overall investment risk. And the third bucket we talk about here is putting this all into the context of your overall financial plan. So when you look at these accounts in the context of the plan, you also then get to bring in consider all your sources of income, liabilities, future contributions and savings, upcoming withdrawal needs and liquidity. So this 30,000-foot view of all your financial moving parts is of great importance to make sure that your family's household financial plan and accounts are heading in the right direction and that you're optimizing your investment choices and your tax efficiencies. So using the end of year here as kind of just a moment in time to check in with yourself and your advisor, I think is really important, as it gives you the ability to confirm that everything is the way you want it to be, or maybe it's time to make some choices. Some may be just a little bit, some may be more extreme, depending on how family circumstances have evolved. So that's the way I would look at the overall investment strategies.
Yeah, that's great. Thanks, Scott. All right. Moving on to topic number 6 of 7, like David said, we're on the down slope here. During the holiday season, many of us are considering making gifts and donations to charities. So, David, can you talk to us about the best way to make charitable gifts and the tax associations or the tax considerations with those donations?
Yeah, okay. There are ways of making charitable gifts that are better than others. And the most common way of giving gifts is just cash, right? Writing a check. That's not always the tax advantage way to do it, because to get the benefit of a tax deduction, you need to itemize. And instead of taking the standard deduction, and about 90% of people who are under the current tax regime take the standard deduction. So you don't get a big benefit if you just give cash, and you miss out on that tax deduction of your charitable contributions. So we want to find the most efficient way to make a gift, and probably the most important one is to give appreciated stock, low cost basis, an investment that you've had for a long time and it's appreciated a lot. It may not, maybe it wasn't so long, but it's low cost basis, a lot of unrealized gain embedded in it. So to avoid the capital gains tax if you were to sell it and then give the gift of the net proceeds after tax, that's not such a great idea. Whereas if you can give the appreciated stock directly to the charity, and even though you can't itemize it, you're saving on future taxes, meaning that capital gain that would have been in your portfolio is actually being handled now by the charity. So that's a quick example of how to give appreciated stock. And Rachel's going to sort of show us a couple examples.
Yeah, so let's just walk through this example we have on the slide here. So let's say you bought Happening Company stock years ago, so it's a long-term thing, just for reference, and you bought it for $10,000. Now it's worth $30,000, so you have an unrealized gain of $20,000. So in example one, if you were to sell the stock and give cash, you would take that $20,000 gain times, let's just assume a 15% capital gains rate. You'd have $3,000 in taxes. So you take your $30,000 proceeds now minus the taxes is $27,000 that would go to the charity. So you've paid $3,000 and the charity gets $27,000. Now in example two, if you just donate the stock directly, you save the $3,000 in taxes, and then the charity gets $3,000 more. They get the full $30,000. And what's great about this in both of these situations is if you do itemize, you can still deduct it. So really, you can get a tax benefit from that. But even if you take the standard, if you donate the appreciated stock, you're still saving on that $3,000 future taxes you would have had to pay at some point in the future.
And Rachel and David, this is for accounts that are taxable accounts.
Yeah, right.
Mm-hmm.
So
Yes.
what about for non-taxable accounts like an IRA?
Oh man,
So
what a
glad you
segue.
asked.
Yeah. Yeah, so there's I'll just give the name. It's Qualified Charitable Distribution. Acronym is a QCD, and it's referring to IRA distributions after age 70 and a half. And so it's a way of giving money directly to the charity out of your IRA. And one of the great benefits of this is it can be used to satisfy all or part of your required minimum distribution for the year. So it can reduce it's definitely an improved tax act. And
Yeah, and even if it doesn't reduce it this year, you still have to take more. Hopefully, it can help reduce RMDs in future years if your balance is smaller.
just by reducing the size of the IRA. Yeah, right. Yeah, so the only other point I would make about QCDs is they have a $100,000 limit, and you can talk to your financial advisor about the details of working through that. And then Rachel's going to walk us through this example.
Yeah, so since $100,000 in the limit, that's a nice even number. Let's just go with that as our example. So in example one, if you were just to take that $100,000 as a distribution and then give the cash, you would have to pay taxes. So let's just assume a 20% blended federal rate. Now this is different because before when we were talking about the stock, that's capital gains, and this is talking about an income tax rate. So again, let's just assume a blended federal tax rate of 20%. So you'd pay $20,000 in taxes on that $100,000 withdrawal. So net to charity, the 100 minus the 20 is $80,000. So you pay 20, charity gets 80. And this you can deduct if you itemize. Now in the QCD, you can give that whole $100,000 directly. So you're saving that $20,000 in taxes, and the charity gets $20,000 more. So win-win for everybody. Important to note on the QCD, since you're already getting the tax benefit of getting money out of your IRA, you cannot deduct that if you itemize. Okay, so moving on to our last topic, everybody, is one of our favorite things to talk about, which is Roth conversions. So David, can you please explain for the class what a Roth conversion is?
Sure. Just to give a quick description, it's when you move funds from a traditional IRA to a Roth IRA. And so remembering that distributions from traditional IRAs where you got to deduct the contributions up front, anything that comes out of a traditional IRA is taxable, just like a salary again. So if you're moving money from your IRA to a Roth, that is a taxable transaction, meaning it's going to hit your income taxes. You're going to do a Roth conversion, your income's going to go up. Why do you want to do it? Again, it's One reason is you don't have required minimum distributions on Roth accounts, whereas in your IRA, you do. So it embeds a little bit of flexibility about that. One thing we like to emphasize, because it's like, ooh, I have to pay more taxes now to do this. Why would I do this? And so we try to expand the time horizon for interpreting tax impacts. And it's not always best to save the maximum amount of taxes now and have the lowest tax bill possible. I mean, it sounds great, but actually it could be a missed long-term tax opportunity. Ideally, what we're trying to help our clients achieve is a steady tax impact over time instead of the up and down of taxes now and into the future. So Roth conversions can be a very beneficial way to help even out your taxes over your lifetime, but you have to have a little bit of a future look. It's not just a current present concern. So yeah, I'd say that's the reason you want to do a Roth conversion, even though it's going to cost you a little bit of money now.
Mm-hmm. And can you talk to us more about some of the other benefits of Roth conversions?
Yeah. Well, the tax-free growth obviously is very important, and then the withdrawals in the future being tax-free. I'd say those are the two biggest benefits. But again, you're reducing the size of your traditional IRA in the present. You're paying a little bit of tax now to reduce the size of your IRA, which will theoretically reduce the required minimum distributions in your future. So again, it's that whole trying to come up with a strategy that evens out your tax future. And I would say, besides that, from an estate planning perspective, it's much better for your beneficiaries to inherit a Roth IRA than a traditional IRA. Again, it's because IRA distributions are taxable, and in this case, they'd be taxable to your heirs at their personal income tax brackets. So if you've got two sons or children, for example, and they're just happen to be in different ones, philanthropic, or they work for not-for-profits and just have a lot of good work, but they don't make much money, and somebody else who's a doctor and they make a lot of money, if they get a traditional IRA, the doctor with the higher income is going to pay a lot more in taxes on the distribution from the traditional IRA. So if your intention as the owner is to try to create a transfer to your heirs that is more equal in an after-tax basis, a Roth IRA will meet that goal.
Yeah, and even if you don't want it to be equal, it can still be helpful to actually give the amount you want to give to people without having to factor in the taxes, which changes it from your desired amount.
Right. That's right.
One thing I would just add is that we have some very good software. If you're coming to us for help on this, very good software that can put in your various sources of income, and we can kind of fine tune it as to where you get the most bang for your buck on, I'm still in this tax bracket, even if I, convert this amount and I have a taxable event. And if I take out more than this, at what point do I jump up in tax brackets? And, there's a whole discussion around that. So yeah, that's where you come in on a personal basis to have that type of conversations.
Yeah. And one little final point, which actually isn't very commonly talked about, at least in our experience, which is how a change in filing status is something worth considering and preparing for. And the change in filing status, meaning from joint, for example, to single. And when would that happen? Well, if you have a spouse who passes or you get divorced, whatever would cause you to change from a preferred joint filing status to a single status. So even though you don't know what the future holds, it doesn't hurt to begin to prepare for that possibility. And so by putting money into a Roth, you are taking advantage of the preferred joint status, tax filing status now, and preparing for a future that is quite possibly going to be single, who knows when. Again, it's that same idea of looking at your family holistically. We're not trying to just reduce taxes in the present. We want to think about the future and all of its weird permutations and unexpected events and try to create a future that's going to have a smoother tax trajectory. So the only reason we're bringing up Roth conversions now is if you want to, well, let's talk about what's going on in the tax world. Right now, we know that come January 1 of 2026, the current tax environment sunsets and it reverts back to what it was in 2017 if Congress doesn't do anything in the meantime. But the sunset back is a less preferable tax environment for one thing. So that means you've got 2023, 2024, and 2025. Basically, if you can get something done in the next 2 weeks, as far as the Roth conversion goes, you've got one out of those 3 years that you've taken advantage of. You can spread out the tax hit that you take over 3 years rather than 1 or 2 or whatever. So it's just an opportunity that we're have available to us now.
Yeah, and not just the tax rates changing, but since we're approaching the end of the year, we've got 12 business days left to actually do a Roth conversion for 2023. So we don't want to miss out on that opportunity.
Right.
If that's something that fits into your plan, of course.
So Rachel, can you give us a couple of examples that we've worked with for Roth conversions?
Yeah, these will be the last examples that we have.
Yeah,
right?
2 more examples.
We're almost
and then
done,
we'll
guys.
wrap up. So if you have any questions, feel free to go ahead and send them through the Q&A and we will answer them in just a few minutes. All right, so the first example I want to give is for a client who we just helped and do this kind of for a legacy planning tool. So this client is a retired single filer and she's a very strong, what we call base case scenario to where she's not really at risk of running out of money, even in extreme circumstances. So one thing that we have really been encouraging her to do is not just think about her own lifetime, but think about, the transfer of wealth to her heirs. So she has a pretty long time horizon, even in her own life. So one thing that we suggested is making a pretty big Roth conversion this year. And we will continue making, adjusting, like Scott said, every year to kind of fine tune it, but making Roth conversions to help pay the taxes for her heirs now. And what's one thing that's really great about this is, yes, there's still the desire to prepare for that transfer of wealth upon her passing. But she doesn't want to release control of the funds yet. So the Roth IRA is really great because she can prepare to have this great legacy thing to pass down to her kids, but she's still remaining in control of the fund. So if there is a situation where she needs it, she has it. Okay, so our last example, all right, just walk with me on this one. So let's just say that in 2023, from your salary or investment income, RMDs, whatever it is that makes it up, let's just assume you're going to have a total tax of $33,000, okay? And you're married filing jointly. Now, let's say you want to do a $50,000 Roth conversion. You would pay an additional $12,000 in taxes on that $50,000 Roth conversion. Now, maybe you don't want to do a Roth conversion. This concept and numbers still would apply if it was just an extra IRA distribution as well, or the concept still applies. Or now all of a sudden you're having to take a $50,000 RMD.
Rachel, if it's an IRA distribution, you need to be 59.5 to not have the penalty, whereas the Roth conversion can be done at any age.
Yes, thank you for adding that. Good point. Okay, so base case, you pay $33,000. If you do this $50,000 Roth, just go with the Roth conversion example, knowing those other options apply. You'd pay $12,000 in taxes if you're filing jointly. But now, let's say for whatever reason, you are filing as single. Moving that same $50,000 out of your IRA is now going to cost you an additional $15,000 from what it was when you were married filing jointly. So $15,000 just because of the tax brackets, y'all. That's pretty significant. So one thing that we really want to point out is that's not just let's say this is an RMD, right? That $15,000 extra that you have to pay because you're single now versus filing jointly, that happens every year. So that can really become a significant amount. So that's why we really want to try and prepare to make the RMDs not so crazy when it's time to take your RMDs. Because when you're in that situation, you're kind of stuck. And unless you want to pay a whole lot of taxes, there's not much we can do. So we really want to try and prepare for that shift in status. All right, that's the last of our examples. Scott, you want to wrap it up?
Yes. So we're going to have this slide deck for you, and the last page here just kind of summarizes it. As a business owner, selecting the right type of retirement plan can make a big difference. The 401k you really need to have done before the end of the year, but some of these other ones you have up until your tax filing deadline to create them. If you're not a business owner and you just want to fund your own accounts, make sure you're funding your retirement accounts through your work or the IRAs that we talked about, health savings account if it's available, maybe this 529 plan for college savings. Consider harvesting tax losses. If that's something that you think might be a benefit, consider the Roth conversions that David and Rachel just talked about, maybe accelerating some IRA withdrawals. And then on the gifting, we talked about donating appreciated stock from taxable accounts to help make those donations more tax efficient, less taxes for you, more for the charity. Same with qualified charitable distribution. So at the end of the day, it's all about aligning your life with your wealth and just being aware of these type of topics. And so with that, I'm just going to conclude this and see if there are any questions out there. And if you can take this when you get this slide deck, you can scan these fancy new QR codes and get our contact information, or you have it at the bottom of the screen on each of the slides. And a number of the people on the call today are our clients. You just call your service rep and they'll be able to help you as well. So
yeah, and if you scan the ones that are the contact, it'll download or give you the option to save our contacts as like a contact card. Then if you scan the business page one, it'll give you the option to schedule with us.
All right. Well, with no other questions, I think we'll wrap it up here. Thank you very much, everybody, for joining us on our first live webinar. We're going to be doing more of these next year. And Rachel will put this recording on our website, but then Rachel's going to send out the slide deck and a few follow-up pieces of reference material for you for your reading pleasure. So,
yeah. And if you have any questions, feel free to reach out to any of us or your Century rep.
Great. All right, everybody. Thank you. Happy holidays.
Thanks, everybody. Happy holidays.